with our plenary session and the release of the directory. But before that, we'll have a wash award. May I request all our guests, our delegates, our invitees to kindly join us inside if they're outside and they can hear us to kindly join us inside. And may I request all our members who are inside the hall to kindly be seated. We wish to begin with our wash award, followed by the release of the directory, and it shall be followed by a presentation and the plenary session too. Once again, at the cost of being repetitive, may I request all our members who are outside the hall to kindly join us inside. This is a moment of celebration and exchange, and we wish to begin on time. And may I request everyone to kindly settle down and kindly keep your electronic gadgets on silent mode. I thank you for your kind attention. Ladies and gentlemen, once again requesting everyone to kindly settle down as we now wish to begin with our wash awards, which will be followed by the release of the directory, and it shall be further followed by a presentation and the plenary session too. Once again requesting all our members who are outside the hall to kindly join us inside, and once again requesting all our members who are present inside the hall to kindly settle down. Please be seated. Thank you so much for your kind attention. With the wash award, may I request everyone inside the hall to kindly be settling down. May I request everyone to kindly be seated. Thank you so much. Ladies and gentlemen, after very enterprising 3 breakaway sessions where we had very illuminating discussion, we are now welcoming everyone present in the hall for the Sa-Dhan and Water.org awards for top contributing financial institution in water and sanitation financing. Ladies and gentlemen, we begin by thanking our jury. Please join me as I would be inviting our jury onto the stage. We are very grateful to our esteemed jury member for deliberating a very tough job of picking up the winners out of the promising participants that we have. And may I request the jury members to kindly join us onto the stage for the Wash Award ceremony. May I request Dr. Prasun Das, Secretary General Apraka, to kindly join us onto the stage. May I invite on stage Dr. R.K. Singh, CGM SIDBI, to kindly join us onto the stage. And may I also request our jury member, Mr. Sajid Ahmed from Water.org. Sir, kindly join us onto the stage. May I also invite on stage ED and CEO Sa-Dhan, Mr. Gigi Maman, to kindly join us onto the stage. A very, very auspicious and very celebrating moment for all of us as we are going to announce the Wash Awards. Ladies and gentlemen, the Wash Award winners for 2024-25 has various categories. There are roughly about 6 categories, in which the first category is microfinance institutions, and under this category there are further 3 categories. And there would be top performing bank as a category, top performing SHPI, and then there are 3 special appreciation. May I once again request all our guests to kindly settle down. Announcing the first award under the category Microfinance Institution, and under this we have furthermore division into 3 categories. Our first category is Top Performing Microfinance Institution, AMU under 300 crore, and it goes to Sanghamitra Rural Financial Services. Very congratulations, Sanghamitra. Inviting Sanghamitra Rural Financial Services to kindly join us onto the stage and receive the award from our jury member. Huge round of applause, ladies and gentlemen. Let's celebrate this moment together. This hall can have more energy with so many of us here, and let's put our hands together. A huge round of applause, ladies and gentlemen. This is still not very loud. Can we have a huge round of applause, please? Presenting the award under the category Top Performing Microfinance Institution, AUM under 300 crore, goes to Sanghamitra Rural Financial Services. They're receiving the award from our jury member, and now it's being clicked. And it's being embedded in our memories and being captured in various lenses. The next category is Top Performing Microfinance Institution, AUM 300 crore to 3,000 crore. And the award for the top performing microfinance institution, AUM 300 CR to 3000 CR, goes to Sonata Finance Private Limited. Many congratulations to Sonata Finance, and since members from Sonata Finance are not present currently, we have member from Sa-Dhan who is receiving the award on behalf of Sonata Finance Private Limited. Congratulations to Team Sonata. We now capture this in our lenses. Thank you so much, juries, for doing the honors. Our next category is Top Performing Microfinance Institution, AUM above 3,000 crore. And that award goes to Muthoot Microfin. We have members from Muthoot Microfin coming onto the stage. Congratulations, Team Muthoot Microfin. This is under the category of Top Performing Microfinance Institution, AUM above 3,000. Congratulations to the team, and they're receiving the award from our jury members. This is a moment of celebration, huge efforts and the recognition. We now move to our next category, which is the Top Performing Bank. Ladies and gentlemen, under the category of Top Performing Bank, the award is being awarded to Ujjivan Small Finance Bank. Team Ujjivan Small Finance Bank, may I invite you onto the stage to receive the award from our honorable jury members. Many congratulations to you. A moment of celebration for all of us. Congratulations. Ujjivan Small Finance Bank receives the award under the category of Top Performing Bank. We now move to our next category, which is the Top Performing SHPI. And under the category of Top Performing SHPI, the award is being awarded to Mahila Abhivruddhi Society, Andhra Pradesh. Congratulations, team AP Mas. Congratulations. This is the award which is being awarded under the category of Top Performing SPHI. And it's being awarded to Mahila Abhivruddhi Society, Andhra Pradesh. And we quickly capture this in our cameras. And we move to our next three categories, which are the special appreciation. We have three special appreciation. And the first one goes to Nab Samruddhi Finance Limited for their continued efforts in Watson financing. Many congratulations to Nab Samruddhi Finance. May I request Nab Samruddhi Finance to kindly join us onto the stage. Congratulations to the team. May I invite you to kindly receive the award from the jury members. The Special Appreciation Award is being presented to Nab Samruddhi Finance Limited for their continued efforts in Watson financing. Congratulations to the team. We quickly take a click. And our next special appreciation is being awarded to the Unity Small Finance Bank for their continued efforts in Watson financing. May I invite Unity Small Finance Bank to kindly join us onto the stage. Ladies and gentlemen, we couldn't bring in some more energy. Can we put our hands together and celebrate this moment together? As I now invite Unity Small Finance Bank to receive the Special Appreciation Award from our jury members. It's being awarded for their continued efforts in Watson financing. Our next WASH Award, Special Appreciation, is being awarded to IIFL Samasta for their continuous efforts in Watson financing. May I invite the team IIFL Samasta to kindly join us onto the stage. With a huge round of applause. The Special Appreciation Award is being awarded to IIFL Samasta for their continuous efforts in the Watson financing. A big thank you to all our jury members for a great job. It's been a very difficult job to pick up the awardees from a very promising list of participants. Ladies and gentlemen, can I request you all to give a huge round of applause to our jury members for performing such a tough task. Thank you so much, sir. We now move to yet another exciting moment, and we are talking about the release of the Microfinance directory. To do the same, may I request CGM RBI, so Jyoti Prakash Sharma, to kindly join us onto the stage. May I also invite Mr. Satyaki Rastogi, who is the CGM SIDBI, to kindly join us onto the stage. I also invite Mr. Nirupam Mehrotra, Director Bird, to kindly join us onto the stage. And may I also invite on stage ex-DMD SIDBI and board member of Sa-Dhan, Mr. Ajay Kapoor, to kindly join us onto the stage. May I request Mr. Ajay Kapoor to kindly join us onto the stage? May I also call Mr. Saeed from Muthoot to kindly join us onto the stage. Ladies and gentlemen, please join us as we move forward with our release of Microfinance Directory 2024. Ladies and gentlemen, the release of the Microfinance Directory 2024. The release of the directory, which all we have been waiting for, Microfinance Directory 2024 has been released by our honorable dignitaries.
I would request all the participants to kindly collect a copy of the directory and a copy of the BMR from the Sa-Dhan desk, which is outside the conference hall.
We now move to our plenary session 2. Please join me as I invite our honorable speakers and the moderator of the session onto the stage. May I invite on stage Executive Editor, CNBC TV 18, Ms. Latha Venkatesh, to kindly join us onto the stage. Very warm welcome to you, ma'am. Ladies and gentlemen, please put your hands together as we invite the moderator of the session. And also may I invite on stage CGM RBI, Mr. Jyoti Prakash Sharma, to kindly join us onto the stage as one of our esteemed speakers. May I now invite Mr. Satyaki Rastogi, CGM SIDBI, to kindly join us into the stage. I also invite MD Svatantra Microfin Private Limited, Mr. Vineet Chattree. And may I also invite MD Midland Microfin Limited, Mr. Amardeep Samra. We now invite on stage Regional MD South Asia, CRIF, Highmark, Mr. Sachin, Seth. And I also invite on stage MD MicroSave Consulting, Mr. Manoj K. Sharma. Ladies and gentlemen, Before I hand over the session to the moderator of this session, we have a short presentation by Sa-Dhan and Dwara. And may I request from impact of new, it's about the impact of new regulations. And may I request Shomini Prasad to kindly join us onto the stage for the presentation. And it shall be followed by the plenary session. Requesting the audio-visual to be ready with the presentation. Presentation by Shomini Prasad. Somni Prasad's presentation. Is it uploaded? Over to you, ma'am.
Good afternoon, everyone. It's a pleasure to be here. My name is Somni G. Prasad. I'm a senior researcher at Dwara Research. I'll very briefly introduce our organization. We are an independent, non-partisan and not-for-profit policy research institution based in India. Our mission is to ensure that every low-income household and small enterprise has access to complete, suitable financial services and social security through a range of channels that enable them to access these services in a secure and confident manner. Since 2008, we have deeply analyzed and carefully written about financial inclusion and social security in India from policy, regulatory, and practitioner perspectives that are anchored to our mission. I'm here today to present the key highlights from a study we conducted this year along with Sa-Dhan. The objective of the study was to understand the impact of the Reserve Bank of India's new microfinance regulatory framework on microfinance customers and the industry. I'd like to thank Sa-Dhan for this opportunity to present on this very important and pertinent topic, given the developments we've been witness to in the past couple of months. Over the next 10 minutes, I'll be first presenting a snapshot of the study design, followed by the key findings. The study was conducted between February and September of this year. Its main objectives were to understand how microfinance providers are reshaping their policies and practices to implement the new regulations, document any challenges they are facing in the process, and understand how customers are experiencing the new regulations. We conducted the study along 4 key themes that you see on the slide. All the key regulatory requirements under the new framework have been folded into one or more of these 4 broad themes. A small sample of MFIs that are members of Sa-Dhan, totaling to 13, participated in the study. For each of the participating MFIs, 3 sets of interviews were conducted, subject to availability. Interviews with management, covering chief executive officers and senior management overseeing operations, risk management, and compliance functions. Field staff, covering regional heads, branch heads, and loan officers. And finally, customers of the participating MFIs. While senior leadership interviews were region agnostic, providing organization-specific and industry-wide insights into the operationalization and impact of the new framework, each sampled MFI was mapped to a specific region and state for field staff and customer surveys. Therefore, through the sample MFIs chosen, our study covered the northern, southern, eastern, and western parts of the country. While management interviews were conducted virtually, interviews of field staff were conducted in person through branch visits. Using a combination of telephonic and in-person surveys, we interviewed 771 customers of 10 MFIs. 3 categories of customers were interviewed. Customers whose loan applications had been rejected in the past 2 years since the implementation of the new regulations, customers with active loans and regular repayments, and customers who were delinquent on their loans in the past 2 years. I'll now move on to the study findings. Before going into the specifics aspects of the regulation, I'll first present key highlights that speak to the state of the microfinance borrower. Given the change in the approach mandated to assess the repayment capacity of borrowers, we posed questions to customers to understand their indebtedness levels and general capacity to make loan repayments. 50% plus respondents reported that they had 2 or more microfinance loans, general loans outstanding at the time of the survey. This includes microfinance as well as other loan obligations of the household. Similarly, 50% plus respondents reported that they had 2 or more microfinance loans outstanding at the time of the survey. Borrowings from banks, self-help groups, and other NBFCs, as well as gold loans, were some of the other loans mentioned that were part of the household portfolio. Among those who were administered phone surveys, which is about half of the customer survey sample size, 21% of them said that more than 50% of their income goes towards servicing all the loans that the household has taken, which includes microfinance as well as other loans. Further, MFI field staff also had some insights to offer on the theme. We asked them if they had encountered customers who had taken more loans than they could handle, given their income and repayment capacity. The proportion of such customers was observed to be between 5% and 20%, and in some cases, even up to 50%, depending upon the region of operations. In the remaining time, I'll be presenting some of the key highlights that emerged from our study along 4 themes. Some of them, while not directly attributed to the new regulations, were a recurrent theme in our conversations with providers. The first theme relates to assessment of the repayment capacity of borrowers, which requires microfinance institutions to build an income and loan obligation picture of the borrower household. In relation to this, the lack of reliable data emerged as a key challenge to underwriting the risk of microfinance customers appropriately. The sampled MFIs verified household incomes reported by customers using various proxy data points. However, given the informal nature of employment of the microfinance customer segment and the instability in incomes that come with it, the lack of reliable data to verify self-reported incomes was still reported to be a challenge. Household income assessment, therefore, was observed to be a subjective exercise, highlighting the risk of income being misreported. In understanding the loan obligations of borrower households, issues with credit bureau infrastructure were highlighted. These were threefold. 1, the non-reflection of records related to specific types of loan products. 2, the loan records of some borrowers were found to be split across multiple KYCs, obfuscating the borrower's debt profile. The last issue concerned the low frequency of updates to credit bureau records, both regarding loan applications made by borrowers and loan repayments. On loan applications specifically, the lack of visibility over applications made by customers with multiple MFIs in the same time window was highlighted. In both cases, even if MFIs assessed borrowers' repayment capacity as required, the risk of overestimation of their repayment capacity was highlighted. Another issue, the variation in the definition of a household adopted by MFIs in the industry added to the subjectivity of the household income assessment that I touched upon earlier. Compared to the regulatory mandate, both narrower and more expansive definitions were observed to be industry practices. On the theme of repayment capacity itself, we also spoke to customers whose loan applications had been rejected in the past 2 years due to the new regulatory criteria. Some customers reported borrowing from friends and family, moneylenders, and other formal financial institutions as alternative sources of funds. Reducing household expenditure was also cited as one of the ways in which they dealt with fund requirements in such situations. The next theme relates to the pricing of microfinance loans and competition in the industry. One important insight that emerged from the field staff interviews was the significant increase in competition over the past few years in specific pockets across the 4 regions covered by the study. Higher number of MFIs, they argued, posed a challenge in retaining existing customers, given the number of MFIs who are targeting the same set of borrowers, and also acquisition of new customers. On pricing, as we all know, interest rates have been on an upward trajectory over the past 2 years. Given this interest rate trend and the removal of price caps under the new regulations, we asked customers if they thought the interest rates had changed. We find that 3 in 4 respondents said that they had not observed an increase in interest rates. We offer a few hypotheses that might help explain the deviation in customers' perception of interest rate from the actual trend. One, the affordability. Customers might define affordability of microfinance loans in terms of installment amount rather than a specific focus on interest rates. So, as long as the repayments are in the ballpark of their expectations, an increase in interest rates might not have been felt. Two, interest rates might fade into the background when customers are scrambling for funds. Three, customers' frame of reference for interest rates and the consequent installment burden may be their most recent experience. In recent times, this was the COVID-19 pandemic, during which interest on interest might have led to a higher repayment burden for some customers. As a result, the more recent increase in rates might not have appeared to be significant. The next theme relates to the provision of key loan documents. This includes fact sheets and repayment schedules. 90% plus respondent customers reported receiving key documents as required under the new framework. We also asked customers if they understood the language in which the documents were provided. A quarter of the respondents who had received at least one of the documents reported that they either did not understand the language in which the documents were provided or could not read or write. The last theme relates to loan repayments. One of the key concerns that emerged from the provider survey on this theme was the erosion of group culture among microfinance borrowers, a practice that is seen as key to the functioning of joint liability groups. This erosion, providers pointed out, made group meetings challenging to convene, and as a result, group guarantees a difficult mechanism to enforce. On the same theme of loan repayments, we also asked customers if they faced any financial difficulties in meeting their installments. About 1 in 10 respondents said they faced difficulties even though they paid for their installments on time. Health emergencies and income shocks were the most cited reasons. We asked customers how they managed to make the repayments despite the difficulties. Customers cited borrowing from friends and family, savings through reduced expenditure as their primary sources of funds in such situations. Respondents also reported borrowing from other MFIs and formal financial institutions in some cases. Overall, most of the providers who participated in the study viewed the new framework as a positive regulatory development, given its push towards creating a level playing field among MFIs in the industry, and also the clarity it has brought to the regulations. However, our discussions with them surfaced challenges to implementing the new framework, as well as ambiguous at best impact on microfinance customers at this point, given the evolving regulatory landscape. This brings me to the end of the presentation. Thank you all for listening. As a parting note, I'd like to add that we'll be happy to discuss some of the findings offline. Our Executive Director, Dr. Amardeep Ghosh, is here too, and if you wish to discuss the findings, please feel free to seek us out. Thanks a lot.
Thank you so much, Ms. Prasad, for that wonderful presentation. And ladies and gentlemen, with that, we start with our plenary session 2 on the new regulatory framework in microfinance, experiences so far. And may I request the moderator of the session, Ms. Latha Venkatesh, to kindly take over. Over to you, ma'am.
Thank you very much. And I think the presentation made the task much easier since it has brought out, at least in some numerical terms, the impact of the new regulatory framework, which is the theme of the discussion. I must congratulate Sa-Dhan first for the evenness of the panel over here. We have one regulator who has imposed the new regulations or announced the new regulations. We have two people who are the people on whom the impact is, that is Midland and Samra, Mr. Samra's outfit, who will tell us how the experience has been. Two people whom I would say are kind of the neutral observers, Mr. Rastogi from SIDBI and Mr. Sharma from a consulting background, who will be perhaps the neutral party, and someone who's going to tell us the measures, that is CRIF, Mr. Seth. So I would say the extremely evenly balanced and representative panel is what we have over here. We'll start with the regulator. The important point is the rules changed, and just to repeat what the presenter said, before 2022, the key part of the rule was that interest rate was capped by the regulator at 10 to 12% above the cost of funds, or a cap of 2.75 times the average base rate of the top banks. That cap got removed for microfinance guys. It was anyway not present for banks, so that level playing field was the big ask, and that's what the new regulations gave. But the new regulations brought two other definitions. One is, what is the household income, which defines the microfinance target group. That will be 3 lakh. Household income with 3 lakh would be the target group. And the cap was in the form of the amount of money that they would give for debt servicing. That has to be 50%. So those were the two new rules that came in. There were other rules which are qualitative in terms of you should not have usurious lending practices. You should be very clear in exactly what is the burden imposed on the borrower. Those were the qualitative conditions. So straight away to you, Mr. Jyoti Prakash Sharma, the CGM from Reserve Bank. Why did you change the rules? I think it's working, sir.
Working? Okay. See, you have partly answered my question. The question is, why did we change the rules? Just allow me to go back in time a little bit. The original MFI regulations, they came out in 2011 after the AP crisis. At that time, we did not have any entity which was classified as NBFC MFI. So after the AP crisis, we categorized a new set of NBFCs as NBFC MFIs and came out with the specific regulation for those NBFCs. That was the time when microfinance sector was, it was served by those MFIs. Banks were not there. But then, as has happened in other areas also, like in gold loans and other things, wherever NBFCs succeed, then banks follow. Here also the banks followed. And then there were mergers and acquisitions. So the net result was the MFIs, which covered 100% of microfinance sector, their market share was reduced to about 30-31% by March 21. So the implication was that our regulations, which came out in 2011, they were applicable only on 30% of the microfinance segment. That was one thing. The borrowers were being denied the benefit of our regulation on one side, and on the other side, the 70% of the lenders, they were enjoying the arbitrage. So, to extend out the benefit of our regulations to the 70% of the borrowers, we thought that we should change our regulations a little bit. I mean, there were other intentions also, but the main reason was that we wanted to extend the benefit of our regulations to the remaining borrowers also. That was one thing. We were also thinking of shifting to activity-based regulation rather than entity-based regulation. In fact, this is the first piece of regulation which is entirely activity-based across all the entities. Before that, we had regulations for banks, NBFCs, separate kind of regulations, but this is the first piece of regulation which is entirely activity-based regulation. So, you have also listed out several regulations which were there in the original MFI regulation, like, cap on interest rates or cap on number of MFI NBFCs.
Only two of them.
There could be only 2 NBFC MFIs which could lend to a borrower. We observed that those regulations were not very effective, for various reasons. For example, the cap, it was not effective in the sense that although we had said that this is a cap, first of all, it was applicable only to 30% of the loan segments. And the second, the entities on which this regulation was not applicable, they were also charging almost at par with the NBFC MFIs. For example, I mean, the banks which have a cost of funds of 5.5 or 6%, they were also charging at 24, 25, 26. Last effective was about 23.5. So there was an arbitrage. We wanted to end that. We wanted to have a level playing field. So, these were the main things. Other than that, I mean, there were smaller issues which we wanted to sort out. But these were the main criteria because of which we wanted to have a new regulation.
Fair enough. Before I come to asking you whether you are happy with the change, let me ask the people who are impacted. So I'll go to Mr. Samra and Mr. Chattree first. Mr. Chattree, have you all been able to implement it? The point which the presentation also made, assessment of income, has that been, a smooth affair? Everything hinges on that because 50%, the real cap is that you cannot give loans beyond 50% of the serviceability, 50% of the income going to serviceability. Have you been able to zero in on how to assess income?
Yeah, hi Latha, thank you for that question, and that's a very important element of this entire regulation, because as Sharma sir said, at the end of the day, FOIR is the key aspect in terms of controlling the indebtedness or rather undertaking any credit assessment, right? And it has two words, I and O. And it is very important that we need to have that I and O very clearly defined if you have to really work effectively in terms of controlling the overall indebtedness. Now, we also do understand, and in fact, I would go back a couple of steps back when these regulations were being discussed. We also were internally thinking about that whom are we catering to? We are primarily catering to the economically weaker section, primarily catering to the households in rural India, which is all informal economy. And in that scenario, there will be very difficult, and I would rather say that any point in time you can say, I have assessed income absolutely bang on. These are not formal incomes, they don't get salary certificates, or for that matter, many of them do not even put an IT. They're not into the IT assessment gambit. So you have to take a certain call. Industry is learning. Most of us in the industry have now, when it all came, we actually moved from, let's say, the step one, which was essentially a declaration and corroboration, to now declaration and validation. And I will explain the difference. The difference is you can actually declare, ask what's your income, and then you go to the household and look at the household scenario, look at what is the kind of asset available and kind of triangulate the whole thing. But then there are always deltas because beyond a point you can't understand whether the asset belongs to the person or to the neighbor, right? The case being a cow. Now whose cow is in the shed? So what you actually end up doing is now creating a little bit more structured income. From declared to basically now we get into a more structured validation, where most of us are now using the wealth of data, which again has come from the help of regulation, where we are all supposed to now declare the household income in our CBs. This is also one of the change in the regulation. That
I didn't get you. How is your assessment changed now?
So what is happening is we are now getting into a structured income. So for example, once somebody declares, we are all running statistical models behind. So suppose you tell me that in Karnataka, in a particular district, I own X amount of acres of land. Your statistical model defines what's an income that is likely to be median. So you can actually validate the statement made by the customer. Or for that matter, in an X profession or a Y profession. That's one way. Second is, one of the changes which also happened in the regulation was that we had to now start giving household income to the bureaus. That is also, by the way, it's just 1.5 years. As the data become richer, as more and more people actually come into the ambit and we give the loans, that data will also create a statistical evidence in terms of the validity of that household income.
You have to give this data to the
credit bureaus.
CRIF. Okay.
Absolutely. Which it will also create a very rich database of the customers over a period of time, right? So the statistics or analytics is what is going to come to help of us when we look at this segment. There is no other way that you can actually take this complex problem and solve it.
No, my sympathy is with you because you are dealing with something which is difficult to assess. It's a cash economy, as well as you don't even know, what the produce will fetch. If he's a fruit seller, you don't know the price. So there will be a problem of assessment of income. Mr. Samra, a more general question. How has life changed before and after?
Before I say anything, I would like to thank Sa-Dhan for, entrusting upon this responsibility to speak for the lenders. This is a very esteemed, panel. At the outset, I must say, the industry has evolved. The expectation of RBI was, the onus now was on the board or on the companies to set the lending rates. So that was a very, very important responsibility entrusted upon by the regulator on the companies. So this was very, very crucial, these guidelines. But having said that, we sometimes tend to forget the economic cycle and the catastrophic event of COVID. We were coming out of that. At that juncture, RBI did for me as a practitioner, did the right thing at that juncture to come out with these regulations, keeping in mind the events which I just mentioned. So, having said that, we need to understand why RBI did this. So that's, sir also already very, very, in a nice way, he explained that why RBI changed the regulation. Now your question is, how is the life
How did
post?
life change for you?
The life?
I mean, did you find less competition? Could you increase rates? After all, the big change appears to be that the cap is off.
The life in the beginning, we were very, very happy because we were all under one umbrella. These were harmonized regulations. We were all under one umbrella. All SFBs or NBFCs, all regulated entities were under one umbrella, which was very, very important. Pre these regulations, there was no restriction on the banks or other than MFI, the entities which were lending to the strata, we are lending to, they were not under the guidelines. So for us, in the beginning, because life was very, very good. Today also, what philosophy we have in our company is that we always think about the sector. We just don't think about ourselves. We are a very small player. We always tend to grow gradually and stringently. So for us, life has been good post the regulations. RBI is very conspicuous in their expectations. So we need to have more and more responsibility amongst to see there shouldn't be any over-indebtedness, or the customer grievance mechanism should be better. More technology should be brought into the sector, which we've done. We've introduced customer app, as Sadhav also mentioned in the morning. So we have better connect with the customer grievance mechanism is more strengthened. So these all things, I must say, are all good about the new regulations. And what things we need to have, I must say, the industry is we are getting to the bottom of pyramid. We should be a little more conscious about the cash flow analysis a little bit more, keeping in mind the present scenario. And, on a lighter note, I must say, this is not a 100-meter race, it's a marathon. We must keep this in mind. In the long run, we must keep in mind about the sector, not just our own companies. Growth, gradual growth, what is need of the hour, and our regulator also. They keep telling the sector that we should grow, yes, but in a gradual manner, not.
Well, I don't know what to take away from that in terms of your experience. That what you're perhaps trying to say is that therefore, because you have the freedom to charge, it doesn't mean that you could charge anything. Is that what you're trying to say?
If you see the SROs, the active members of SROs, both MFIN and Sa-Dhan, the range is the same by and large, because we are at not even small, not big, we are at medium level, and we are at par with the all bigger and smaller players. Okay. So I think usurious rate of interest are not defined, but as per our knowledge, as per our platforms, the rate of interest by and large are the same. But of late, we have introduced risk-weight pricing. Earlier we were not doing. We have introduced in last 2 quarters. But we understand more and more about the RBI expectations now, and I think going forward, this is going through a little reset. Okay. It's just about 2 years or so yes. Post the regulations, and
No, I'm asking you this because I want my next question to the regulator will be: do the regulations need to change yet again? But we will come to that in a bit. Let me ask Mr. Seth. You are confronted with having to give data on performance. Are you able to give any input, or do you doubt the assessment of household income and therefore the FOIR which is given to you. Is there anything, in any way you can help them to assess household data?
Yeah, thanks Latha. I think a very valid topic, and I think that's one of the core part of the new regulations also. So, I mean, first of all, as my fellow panelists mentioned, that it's mandatory to provide income. Now, what's happening is that obviously we cannot add any value in that, because what's the data come, we just take as it is. We are a more of a agency which...
You have a history of the borrower, no?
Yeah,
That's
yeah,
why
yeah.
I'm asking.
Yeah, but I think what one value add we do provide, and we have offered, and many of the our sort of members use it also, that we can give the trending. So which means that, let's say if the MFI borrower has taken 3 loans over a 3-year period, and the income reported by 3 different lenders is different, we can provide that trending to them, and that gives them a view that what kind of risk they can assess. Because if the income is going high or going low, or is it sort of maybe not in a linear manner, then they can take a call on that.
Are there many instances of borrowers with each lender giving you a different idea of the income of that borrower? Is this inconsistency a frequent occurrence?
I wouldn't say that there is so much of discrepancy that way, but because see what happens that these loans are need not be in a very shorter interval to each other. So let's say loan taken from one MFI,
his income
and
may
then
have fallen
6 to 9,
risen.
and as I think Mr. Chattree also mentioned that their income profile keeps changing. I mean some of the work they are doing is seasonal in nature, etc. So I think the bureau's sort of role is that what exactly is reported and how I'm able to present it back. But yes, validity of that is the MFI's responsibility, and then but at the same time, whatever is the next MFI when they are going to lend it, at least they have a visibility that how income was reported in the last 2 or 3 loans. Yeah.
So that help is there.
Yes, absolutely.
Okay. So as an observer, Mr. Sharma, what is your sense? Do you think that this is proceeding well, that this standard, instead of giving interest rate cap, to go to force the lender to find out the income and therefore the debt serviceability of the household, is that the right way to approach, or can you, pick some better way to do it?
Well, I'll say that let's take a step back and say what is the regulator trying to regulate in the case of microfinance. So typically in any financial institution, the regulator says that, this is how you should be functioning, this is the ALCO meetings are happening, risk management, board governance structure, and so on and so on. The 2 sticking points that we have always had in the microfinance sector are interest rate and over-indebtedness, right? There's always been an issue about, is the client over-indebted and the interest rates are high. The government remains concerned and the regulator remains concerned. These are the add-on challenges that are somehow specific to our sector of microfinance, right? And every time we have a problem in the sector, it is coming from one of these 2 issues. It's never about the regulatory, compliance of microfinance institutions. They're just like any other bank or financial institutions, MFI has always complied, and I don't think there is any systemic problem. Now, one of the challenges, of course, for that is the income assessment. But the larger issue is that if you look at the microfinance methodology, the way it evolved in India in 1999 onwards, propelled by SIDBI, was that microfinance at its core is a methodology where credit assessment is outsourced, right? So you basically tell a woman, form a group of 5 and I'll give you a loan, right? So the whole credit underwriting at the methodological level is outsourced. You're basically saying that tum decide karo kaun 5 महिलाएं हैं, हम loan दे देंगे. We'll decide on the loan amount. But
उनका credit assess नहीं करते. अगर आप 5 महिलाओं को लेंगे, आप कुछ भी पैसे तो नहीं देंगे ना?
उसमें I'm oversimplifying the whole thing. I mean, there are now credit bureaus available. But at the fundamental level, the methodology is that I am entrusting you because now there is a group, there is this whole societal pressure that is supposed to come with the group, and that is supposed to drive repayments and so on. The moment I would say we cross the 25 to 30,000 rupee average loan size threshold, there is a need to assess clients individually, right? And the whole income assessment of the client or the household is one part of that client assessment. The whole thing is that how does this methodology change so that we are able to draw back in the credit underwriting process. ठीक है? क्योंकि at the level of average loan size of 40-50,000 rupees, it's no longer feasible to be able to drive this outside and say that, because it will lead to its own challenges in terms of over-indebtedness. That comes time and again, and of course RBI then has to act, or the government has to act, or the institutions have to act for that matter, and say that how do we address these pockets of over-indebtedness. The other challenge that we have is Bangladesh is a very saturated market. Why don't we have these problems there? We rarely hear that the regulator suddenly did this and the regulator did that. Largely because, see, there are 4, at best 5 large microfinance institutions in Bangladesh. So it's a very limited pool that is available. In India, we have a very large number. The competition levels are at an all-time high. And one of the things that drives repayment in microfinance is the promise of another loan, right? More than anything else, more than group pressure, more than the societal pressure, it is the promise of the follow-on loan that drives repayment. Now, once you have a plethora of institutional options available, even if I default to one, I can at least try and go to. So what's the option for that? What's the fallback mechanism for that? That there are credit bureaus available. But if I start to use multiple IDs, then I try and
You're able to
overcome
sidestep it.
Yeah. So somewhere I think we'll need to go back to the drawing board. This methodology has worked extremely well for us for 25 years. We need to rework the methodology. The regulator will be able to do only so much. It will regulate whatever you present to it. It has core concerns around over-indebtedness, around interest rates. We will have to come up with a response mechanism that says that we have addressed your concerns.
Okay. Well, that brings us to a slightly sticky wicket. As you pointed out, or as is often pointed out, the microfinance industry does go through a difficult time once in 4-5 years. The reason would have been demonetization, it could have been COVID, but with some regularity, 2008, I can't think of a reason, but it didn't go, prosperity brought perhaps its own problems in the wake. Mr. Rastogi, what has led to the current problem of higher default in the MFI sector? And I want to read some numbers which we have got from credit agencies, from CICs. The extent of defaults, that is defaults past due, payments past due date, was 2.7% as of last September. By June, it rose to 4.6%. So there has been a substantial increase. And I could go to others, 91 to 180 days default, even that has increased by almost a percentage point or 70 basis points. So clearly the last 2 quarters have been difficult quarters for the MFI sector. What was the important event before that? Change of rules. So can you link the two? Change of rules led to higher defaults?
So first of all, let me congratulate Sa-Dhan for organizing this wonderful conference and also giving me an opportunity to be here to speak on this very important issue. Whether the regulation is one of the reasons for the defaults, I don't think so. Mainly because, see, why the regulator, for everybody, Sir has already explained why regulator went to do that, but another reason that could have been there was that seeing the industry perform for last 12-13 years and having sailed over 2 very major crises, one is demonetization and the second one was COVID, the regulator felt that the industry has matured and matured enough to be able to, self-regulate itself and conduct its affairs in the manner that, it is good for both the sector as well as the beneficiaries of the sector. So this is probably one of the reasons why it was deregulated. So the interest rate caps were removed,
yes.
and those things.
So you won't relate the increase in difficult loans or defaults to the new rules?
Yeah, what we have seen post-COVID is that post this change in regulations, the industry has seen a phase of very remarkable growth. So very high growth.
Yes, nearly 25% growth is what I understand.
And in that growth, I think somewhere some guards were lowered.
Some euphoria crept in.
Yes, some euphoria crept in. So we thought that this is an ongoing thing and probably the crisis may not come back again, or it is far-fetched now. So we've learned, now that technology has come, we've got so many data points available today to improve our credit assessment. Although, as Manoj said, we've not changed the methodology much, but still, this could be one of the reasons. So what has happened is we've seen very high growth rates in this period. And recently, some guards have been lowered, like multiple lenders, single borrower getting multiple lenders. Borrowers have also become over smart. So
they're able to give you multiple identities.
They're able to give multiple identities and they are able to take loans from different, and it's very difficult for a MFI operating to actually find out how many loans he has taken. So I think these are the issues which have led to this problem right now, where the delinquencies have gone slightly higher, the collection efficiencies have come down. But I believe that with the guardrails put by both the SROs, things will normalize, and this industry is well aware of the problem that is facing them, and they will certainly take care of it.
Okay. But Mr. Seth, you would have the entire family members' data with you? I mean, if they took loans in the names of different members of the family, is that something they can apprehend? No?
Shall I?
Yeah, please, go ahead.
I think he's more keen to answer that. So, ma'am, when RBI defined a household, it was husband, wife, and unmarried children. So, yes, we pull out data from the credit bureau about the overall indebtedness of the family. So, that's a very, very positive about the new regulations. So, it's very, very transparent in this matter.
What is the regulator's observation of your own new rules? Recently, there was an action against a bunch of microfinance companies. What is wanting? I know you cannot name names, but generally what is wanting in the industry?
Yeah, you want me to talk about only what is wanting or what has improved also?
Both. Why not? How happy you are and how unhappy you are.
See, I mean, we can look at it from different angles, you know. Let's take a very high level view on it first. Compared to March 22 or before that, various things have improved. For example, NBFC MFIs, whose share was about 31%, they have regained their #1 position in the whole segment. Now they are about 40%. In fact, before 22, banks had pushed them down, and banks were #1. Now again, NBFC MFIs, they have become #1. Market share is about 40%. That's #1. #2, number of microfinance borrowers, that has also increased by about 40-45% in 2 years. I'm not sure whether that is number of borrowers or number of accounts. I mean, I'll ask Gigi later. Probably it is number of accounts.
I think Mr. Chattree knows. Yes. Number of accounts or number of borrowers.
Unique borrowers.
So the number of unique borrowers have increased.
Yeah.
In fact, if you see in this particular year itself, it has also gone up. And the ratio of active loan to borrowers has more or less remained static. Gigi, please confirm.
Unique borrowers has gone up.
This new the unique borrowers have gone up. So that shows that probably because of the that restriction of going beyond a particular level of indebtedness, they need to look for newer members.
Yeah.
So we are seeing 17-18% of growth in the unique borrower.
So that's what I wanted to ask. So first, market share of NBFC MFIs has gone up. 2, number
Borrowing
of borrowers.
community has gone up, which is the best thing that can happen.
That has gone up. Also, NBFC MFIs, they have expanded to more and more districts where they were not there earlier, were from about 630 to 740, 750. Now, that's a good increase in 2 years. Also, if we see in the market, investor interest is there. I mean, we can debate whether it is good or bad, but fact is that investor interest is there. Overall, this sector seems to have recovered from COVID lows. So that is the high level view. If you look. But now let me come to what is wanting. Manoj has rightly said, over-indebtedness and high rate of interest, harsh recovery practices. These are three evils which have been attacking these sectors since beginning. In fact, AP crisis happened because of these things. And then Malegaon committee pointed out these issues. We came out with new regulations. But, these three things have persisted. Add to that, in the new regulations, we have a very important issue of household income assessment. Now, the whole framework depends on household income assessment. Now, I understand that it is not possible to have 100% accuracy in household income assessment, but some sort of, circumspection is required. We have seen cases where income of the household has increased suddenly from 1.5 to 3 lakhs. In a period of 6 months or 7 months or 1 year, it doesn't happen. No, either the assessment is wrong or it is simply inflated. So when it is inflated, then it definitely leads to over-indebtedness. Earlier, we had a cap of 1.25 lakh rupees on maximum cap on what could be given as a loan, irrespective of household income. So everybody was getting 1.25. So we thought, okay, we'll change to 50% cap on repayment.
Instead of number of loans.
Instead of cap on amount of loan, we should have a cap on what is the repayment obligations. So, but now that obligation is being circumvented by increasing the household income.
The household income.
So, that issue remains. The second expectation was that this will lead to increased competition. That hasn't come. When the competition comes, then interest rates are expected to come down. But then competition, it doesn't seem to be helping the interest rate.
Market is not helping to bring down interest rates.
So, it's overall, it's been good for the sector, at least for the industry. But, the core issues, they are yet to be addressed.
Yeah. So, you all removed the interest rate cap, but the word usurious keeps getting used by the governor, no less, in his speeches. So, would you want to revisit some caps? Number of loans or interest rate, anything? Since your definition of interest rate and the practitioners appears...
See, we are monitoring the situation. Whether we are thinking of it or not, it's hard for me to comment right now, but we are definitely monitoring the situation. Our supervisory department, they are trying to get in touch with various outliers. Right now, we have started talking with the NBFC MFIs and other NBFCs. Probably we'll talk with others also. If they are satisfied with the progress, well and good, but then otherwise, ultimately for RBI, interest of the borrower is paramount. Of course, we understand that that has to be balanced with survival of the lenders also. We are aware about that. But borrowers will get, priority.
Yeah, I can take that. But, I don't envy the role of the lenders at all in this context. You were speaking about, suddenly income going from 1.5 lakh to 3 lakh. I can tell you that has happened in the women who work in my household. She would have been 1.5 lakh going by what she was earning from houses in our building. Her son completed 17 years old, he finished his SEC, and she immediately put him to work because there was a major illness in the family. And actually the income doubled. The boy was earning some 30,000 a month. So clearly the income rose in just a matter of a few months or couple of months. And her hope is to bring that boy back into education when the household income will again fall. So it is a category which is very difficult to assess and where the fluctuation month to month and year to year, quarter to quarter is very sharp. I don't envy their role at all. So let me toss the ball to their court. Would you want any rules changed, Mr. Chattree?
I think, let me start by saying, I think this whole sector, as Sharma sir said rightly, first of all, RBI actually created and actually helped shape the sector earlier based on a certain proxies. In 2011, we were actually operating through proxy parameters, right? There was a definition of number of lenders, there was definition of the household income, there was a definition in terms of the cap of the loan and et cetera, right? Including the interest rates. And as all we have discussed till now, we were talking about the industry which has actually moved on, the customers have also matured, and by the way, the industry which has also grown and matured quite significantly. If you see, it has not only matured, it also become fairly concentrated, right? And at some point in time, if you look at it, we need to graduate from proxies to probably a better credit underwriting processes, right? When it comes to interest rates,
That is a task for yourself.
to us as a responsible
I'm asking you
lender.
whether you want rules rewritten. No.
I don't think so, because even from my point of view, when these rules were changed, and I remember very clearly when these rules were being changed, its regulator has done a job in terms of saying that, look, I'm going to give you a level playing field. I'm going to give you and entrust a certain responsibility to you, right? And regulator can actually work on a binary thing. Sampurn Swaraj hi milega, right? You can't have A, B, C, D, and by the way, I will still do this. So what regulator has done is right. Now the ball comes back in our court. Are we ready to undertake that responsible lending avatar which is expected by the regulator? We talk about interest rates. It's not about what interest rates you are charging. It's about why are you charging what you are charging, right? Each company is different. Each company borrows at a different rate. Each company operates in a different geography. Each company caters to different type of a segment. And that's the essence of risk-based pricing. Are we truly, however, adopting it? And transparently, see, this whole industry has three key dimensions. And as we were discussing earlier, it's about touch. It's about trust. It's about transparency. And what regulator is really saying, I understand your business model is on touch and trust. What we are interested is in transparency. If you are transparent in your interest rates, if you are transparent in terms of assessing your borrowers carefully, we have no problem. And that is what, to your limited question, we think it's a wonderful regulation at this point in time. We as operators have to make sure there is no need for the regulator to come and relook at it for any reason whatsoever. And that is, again, it goes back to all of us.
Sa-Dhan and MFin have both put in a condition of number of loans, 4. Why not the regulator say it then?
No, but just the last thing before you put on to regulator, I think from an SRO's perspective, and Gigi is here, right? The industry moved from proxy to credit underwriting, right? What we all have kind of done, and by the way, many of us, and all of us are practitioners here, all of us, by the way, whoever is responsible lender has taken a mixed approach. While we are doing a right credit underwriting, we always had a mixed proxy guidelines. Our first cycle lender will not get a loan above a certain amount. Our second cycle lender will not get, borrower will not get a loan above a certain amount. What MFin and SRO has done right now, I said, 1 second, let's make these proxies a little bit more stringent so that it is a combination of a credit underwriting and proxy. And a time will come when we mature, proxies can take a second seat.
Fair enough. Okay. Well, a similar question to you. Do you want rules changed or do you want behavior changed?
It's again, I think the most difficult question you asked me. Behavioral change, already it's coming into place. It has come, I must admit this. Since RBI has been more proactive, more frequency of talking to the practitioners have gone up, I must say. Behavioral change is already there, I must say. Rules are, I think, absolutely fine. The SRO is already quite responsible in coming out of the guardrails.
With the guardrails.
Again, let me be very candid and honest. Had these guardrails been there a year or so prior, things would have been a little better. Yeah, I must admit this.
Okay. As an outsider, Mr. Sharma, what is your sense? Do you see red flags?
I mean, the whole thing is that when the regulator sort of came up with the recent changes in regulation, I think as a sector we were all sort of surprised, because doing away with interest rate caps, even though when the interest rate caps really
Do you
happened.
think the caps are good?
No, when they happened, actually we were surprised that the regulator brought it in, because this was the only sector that was sort of singled out for interest rate caps. The fact that the regulator removed the caps meant that the regulator said, okay, here is an acknowledgement, the sector has grown, it has matured, we have built guardrails in the form of credit bureaus, and we are overall sort of happy with the way things have been going. We would like you to grow, and that's what we read into it, that this is an endorsement from the regulator that things are going in the right. I think just as there was euphoria that, you know, the regulator has taken off those caps and has entrusted the sector to you know, fix things on their own. Similarly, for the last 6 months, just as the regulator was giving signal after signal saying that you need to look at your interest rates, you really need to see that some of your lending practices are going, you know, not in the right direction, you need to fix things. So that those messages were being given in private and very much in public. So we read those reports. So I think the sector should have taken those messages a little more seriously, and probably the recent, as I said, the regulatory sledgehammer that RBI uses once in a while, that should have woken everybody up, and I think we will see changes in the sector. That's my sense, ma'am.
Okay. What's your sense, Mr. Rastogi? See, the lender is as much interested in the borrower paying back. What makes them usurious, if using the word of the regulator?
So,
is it the PE investor? Is it that you have to give back an IRR? Is that the reason? Because there was a talk of a cap on ROAs also. Are they making too much profit? Is that the way we have to think at all?
so before I come to actually replying to whether PE investor or somebody, if you look at the industry, it's, as Vineet said, it's highly touch-based and trust-based and transparency. So transparency is obviously something that was expected from the regulation, but trust, and one more thing that is, it's a highly manpower-intensive industry. So here, whether it's origination or collection, everything is very manpower-intensive. So they will have a very high OPEX. These MFIs will have a high OPEX,
and their borrowing, higher interest.
And their borrowing costs are also high. So the interest rate is just a, you know, a derivative out of what is the cost and what is the borrowing cost. So they will certainly have a much higher interest rate compared to banks or
Absolutely.
others.
And I think the regulators accepted that.
So on the counter side of it, if you look at 5 years back, and I was just going through the MFin and Sa-Dhan data, so it's not, and I think in the morning Mr. Manoj Mittal also spoke about it, that 5 years back, the borrowing costs for the average borrowing costs, it would differ from MFI to MFI, was something around 14.5% for the MFIs, which has gone down to 11%. The OPEX has also seen, you know, a 1% reduction roughly. So you see 4.5% reduction in overall costs. But has the borrower benefited? No. The lending rates remain more or less.
The Dwara research said that borrower is not complaining about interest rates,
No,
incidentally.
He will not complain. That borrower will not complain. The women there will not complain because they have.
So you think that the lower interest rates have not been passed on?
Not been passed on. So why they have not been passed on? Is it the investor interest, which requires a higher return? Or is it factoring in some of the credit costs because of the cyclical nature of this industry, and where every 4 or 5 years there's going to be a loss that they have to book into their books? So I think these are the issues that are in front of the industry. They will have to, you know, address it and, you know, come back.
Point that you make more profit in good times, which you can deploy as provisioning when
But I would say that I think we all have to also be cognizant. See, again, as we said, pricing is about transparency, right? We cannot say that, let's say, for example, the interest rates, or rather the borrowing has come down from 14 to 11. It's not for everyone. By the way, we are also forgetting that Ind AS accounting also came in between, where from standard provision, your ECL provisions went up. There are reasons. And so the point is not about what happened in terms of delta. The point is, at this point in time, on a quarterly basis, as the regulator is saying, are you transparently putting those costs? And your returns, now we have seen a lot of debates about what is a right return. Just go to the market. There are 4 or 5 listed entities. What is the cost of equity? You can easily calculate. Cost of equity for any investor would be at a certain expectation, which is, by the way, not my promoters or his promoter. It's actually what market expects when they want to put an equity into an unsecured market. And that cost of equity is there. It's there for everyone to see. If you use this approach, the ambiguities are over. The point is, be transparent in terms of what you are doing. By the way, another point. What we are trying to fulfill in microfinance, a lot of us tend to sometimes forget. When you go to housing loan, the first billboard, the biggest font size number that is put on a housing loan billboard is?
The interest rate.
When we go to two-wheeler loan, interest rate. When you go for credit card?
That's not put.
Okay. When we go for microfinance?
I don't know. What do you put?
It's about availability. See, what you are trying to fulfill as a need of a customer is important to understand. We are here fulfilling the need of a working capital of a customer, right? It's not a housing where I am fulfilling the need of interest rate because it's a long tenor loan. A 2% interest rate in a short duration of 2 years, the delta of 1% is only 20 rupees on an EMI. So we have to also understand what objective we are trying to fulfill before making it a big issue.
It's a very good point. It calls for applause. You're absolutely right that it affects need that microfinance industry answers. And at that point, interest rate is not the a big concern for the borrower, unlike a home loan or, more affording borrowers. I take your point on that. Just a line, since it became an uncalled for headline, I just wanted your views. Cap on ROA, what do you think, Mr. Sharma?
I think once we have moved away from sort of the Reserve Bank capping at any level, I mean, whether it is interest rates or, I think that's the way it probably should be. Because for me, it's about the RBI, as I said, reposing faith that the sector has matured. So let's demonstrate back to the RBI that we are a mature sector. We can regulate, we can self-regulate. And I think that's the way it should be. Any cap of any sort means that, the central bank still considers you to be a kid on the block and is basically, holding a stick to your head. I don't think that's something that we should look forward to. Yeah.
Coming from an outside party, I'm not asking the insiders. Mr. Seth, any suggestions at all in terms of rules or self-rules, SRO-driven rules? No, Mr. Samra, let Mr. Seth.
Fine. So Latha, first, I know we talked about something a few minutes back. I wanted to throw some data points, latest data points, and I'm sure that would be important to the everyone. So we did talk about post the regulations, what is the increase in the loan accounts or individual loan borrowers. We have got the exact data as per reported in the Bureau. So basically, number of individual borrowers increased from 7.4 crore to 8.7 crore. And that's the data from between, let's say, June 23 to June 24. Okay, that's a 14% increase. Now, in terms of the active loans, has increased 14.2 crore to 15.9 crore, and that's basically around 12% increase. So that's a data. I mean, I know we were looking for that, so I just got that. Perfect. Now, coming on, I think very interesting things we talked about. Obviously, as Mr. Sharma also mentioned that, it's all about how do we protect the borrowers, interest rate, how do we balance out, etc. From a company which provides data information, or we are in the business of that, what we are looking at that is that, from underwriting perspective, there are a lot of other levers beyond income can be used. And that's where bureaus tend to work with all our clients here. Let me give you some examples, right? One of the example is that while the regulation does not limit number of lenders to a borrower, but what we do is that when we work with a client, we are ready to provide them the existing number of lenders. Now that is in the interest of the new lender to take a call as per their underwriting policy that, or as per the guidelines, guardrail setup, that whether they would like to become the third lender or the fourth lender or not.
Fair point. I think that's very useful.
Yeah, and let me tell you again, there are data points. I don't want to get into data crunching, but yes, we can have a dialogue that, we can look at that if it increased from 3 to 4, whether the delinquency increased in that. And that data is available with the bureaus for clients, right? So these are some of the sort of additional things which I wanted to sort of bring to the table. As far as the guidelines, what we see have been put in place, I think we see that, bringing everybody on a level playing field has made life easier for us also as a bureau, because, we also had multiple things to sort of look at. And another just point I wanted to highlight is, there is also a cross section of customers who are an MFI in consumer bureau. So there is about 21% people who are actually MFI, but they are also in consumer bureau. So we have the cross tab of that. Oh. So that is again a point that, when we are looking at, we are saying comprehensive report, but we should also look at composite report. So it's not about just family, it is about the individual's bureau report from different bureaus. Yeah. I thought I'll just take time to conclude that. Yeah.
Okay, thank you. I thought I should give some time to the audience. We started at 4, we are about 5 minutes to 5. If there are questions from the house, you all have just 5 minutes. I'm sorry about that. Or you will discuss over tea. No, I think everyone has a claim to catch.
I just want to add one point. I don't think regulator would be specifying about any particular number, even in interest rate. They are more keen about having a transparent way of working out the interest rate. It's not that they are looking at that it should be this number or that number. It should be a transparent way how you work out the interest rate. That's what they are looking at.
Okay. Can I have just monosyllabic, rapid fire? Since there were not questions and hands didn't go up. Okay, there is one. Yes, sir, please.
So, interest rate, cap has one limitation, because we talk of averages, because real life you have real cases. So one is penetration of microfinance. So where you have a good density, lower overheads, a lower cap would work. So if at all, there was to have somebody actually looking at the spreads, a cap would work against the penetration into thin areas.
Fair point, sir.
We got to remember that. That is one. So exclusion should not become, the driver. And that was one problem. I think, when it was needed. But today, with a more mature market, I don't think, that regulator would like to see a measure which can have a limitation on the penetration into, because we still have large, thinly populated areas with addressable market where the competition needs to get in without looking at the cost.
So that's a fair point, sir. Costs will increase when you start to go to outlier areas. The only doubt which the regulator or an outsider would have is the interest going up because you're servicing a larger area, or is it going up because you want to make a larger spread for yourself? Those doubts will always remain. Very quick monosyllabic questions to the participants, that is Mr. Samra and Mr. Chattree. There has been an increase in the number of default loans or percentage of default loans. By when do you think the curve will plateau and fall? Monosyllabic, we have only 3 minutes, sir.
I think it's a little stereotype answer, but the present festival season and I think we see that there is some cash flow improvement at the grassroots level. This is what we personally in our company we've seen at the grassroots level. Things have started improving for sure for us. So I think we are quite positive about it.
So Q3 or Q4 should be a good quarter?
We are positive for that. Okay. And I think Vineet wants to add something.
Mr. Chattree? Yeah.
No, so see, the credit cost is always in financial industry a bit of a parabola. In Q4, you would see the trend, which will be slightly more static or declining. What we are all seeing across in the sector also, that it is becoming more or less static. Now as the disbursements pick up, it will eventually either plateau or go down, is what all of us as an industry player believe.
No, certainly fingers crossed on that. Does the regulator want to have the last word in terms of a message to the industry?
No, I think the market participants, they have assessed this situation very correctly. The regulator has done what it could do, for now. It's for the industry to come forward. Industry has to, it has to, look beyond profit making. Of course, when I say that, it has to be more ethical, and it sounds quite high, but ultimately that's in the interest of the industry.
No, corporate governance is everyone's requirement.
Yeah. So
whether it is media or whether it is microfinance or whether it's banking,
not just
ethics is not a wrong call at all.
Not just corporate governance. When I say ethics, I'm more on the side of the borrowers. If you want to do something good for the borrowers, it's not against your interests. That's what the industry has to.
What is the one thing you want them to avoid?
Avoid inflation of inflating the household income assessment.
Okay. All right. We'll leave it at that. My sympathies are with the industry in terms of assessment of household income, because I have seen it fluctuating in front of my eyes. For people who would be legitimate microfinance borrowers, I have seen the up and down in their incomes. So my sympathies with you, but the regulator will say or do what he has to do. Thank you very much. I think it's been a fruitful discussion of understanding the ambiguities of the scenario in which the microfinance industry operates. And I go back with the positive vibe that the recent problems will also be solved in the very near term. Thank you very much, Mr. Sharma, Mr. Rastogi, Mr. Chattree, Mr. Samra, Mr. Seth, and Mr. Sharma. Thank you very much for a fruitful discussion.
Thank you so much, moderator of the session. Thank you so much for a very stimulating session, I must say. Thank you. I wish we had more time. We could have taken this discussion forward. But of course, we can do that offline. Yeah, yeah, people have to catch their flights as well. Thank you so much, ma'am, once again. Ladies and gentlemen, it was a very stimulating session. Can we put our hands together and we thank our honorable panelists onto the stage? And may I request MD CEO, ESAF Small Finance Bank and Chairperson Sa-Dhan, Mr. Paul Thomas, to kindly join us onto the stage. Sir, could you please come onto the stage and present the memento and the shawl to our honorable speakers of the session? We first present a shawl and a memento to Ms. Moderator of the session, Ms. Latha Venkatesh. Presenting a memento to Mr. Jyoti Prakash. A big thank you to Mr. Satyaki Rastogi. We now present a memento to Mr. Vineet Chattree. Thank you so much, sir. We also thank Mr. Amardeep Samra. Our heartfelt gratitude to Mr. Sachin Seth. And a big thank you to Mr. Manoj K. Sharma. May we also invite on stage Ms. Saumini Prasad, who made the presentation, and once again request Mr. Paul Thomas to kindly present a memento and a shawl to Ms. Saumini Prasad. Ms. Saumini is around. We are now being joined by Ms. Saumini Prasad. Sir, may I once again request you to kindly present a memento and a shawl to Ms. Saumini Prasad. I request Mr. Paul Thomas to kindly present. This is the concluding moment of day 1 of Sa-Dhan's National Conference. Ladies and gentlemen, can we hear it for everybody for participating so well? A huge round of applause. We're coming to the concluding point of day 1. And we click that and put it in our lenses and, of course, in our memories, absolutely embedded. With that, ladies and gentlemen, we conclude our day 1 of our national conference, our Sa-Dhan's National Conference on Inclusive Growth 2024. We request you all to kindly join us tomorrow at 9:30 for us to begin with our first session. Our first session would be a fireside chat.
Before the members leave the hall, let me also announce that there is a meeting of MFI CEOs and CXOs in room number 219. The first part of the meeting would be with the BCG team and NABARD for about half an hour. Thereafter, there will be an internal meeting of the CEOs and CXOs in room number 219. Please assemble there immediately. Thank you.
Thank you so much, sir, for that announcement. Please join us for the meeting. Ladies and gentlemen, please do not forget to take care of the belongings, and also may I request you to put your phone back to the ringing mode. Please don't forget to put your phone back to the ringing mode. Thank you so much for participating so well. I'm Sushmita signing on from the podium, and I request you to kindly join us in time at about 9:30 tomorrow for us to begin with our first session. Our first session tomorrow is a fireside chat, a discussion on the role of microfinance in the journey towards Viksit Bharat. And with that, we request you all once again to take care of your belongings. Namaskar, and have a great time ahead. Thank you.